Let's go move on to Kenneth. This is a great discussion, great topic, Kenneth. I actually had a similar discussion with a coaching session yesterday at 5 p.m. afternoon. Kenneth asks, is there a rationale for selling covered calls at different strikes on the same stock? Some people say that there is, and I can't argue with that, but it depends on your outlook for the position, Kenneth. And what I mean by that is, what are your expectations for the stock? What are your goals for the stock? What are your goals for the return? Just like we talked about with the married put that Victor asked for. And what are you willing to give up with the capped gain, as we just talked about with Goose and some of those other positions? It's called laddering, Kenneth. It's a term we don't really use. Ernie doesn't prefer to use it this way, and you kind of know why. The reason why he doesn't necessarily use the laddering technique is he sort of goes all in. If he buys 500 shares, he's maximizing his premium with the ATM bell curve and the married puts by selling the 5 calls at the money at the strike he thinks is the best choice. There's different ways to ladder. We're just going to discuss the simple way. Okay. Apple, why not? Popular, still strong, getting in more favor with the market recently. So let's put in, we're going to buy 100 shares today at our price of 172.57. And I want to go out 14 days. Okay, now I'm just going to do, let's say I did the at the money at 175. Okay, so we're going to buy shares of stock. We're going to sell the 175 call here. Now, it's pretty much at the money. Oh, is there a 172.50? I'm going to use, I apologize for this. Let me use the 172 or 172.50 first. We're going 14 days out. Yeah. As at the money as you can be, Kenneth, taking advantage of the at the money bell curve. This has the highest time value of all options on the chain right now for that expiration. Not the highest premium, the highest time value. Its time value is $2.70 roughly. Okay, so the at the money strike, highest time value, 50-50 chance of being assigned, a return of 1.6%. Yeah, that looks a little bit low maybe, but again, it's Apple, and it's also only 14 days at a time. That's 0.8% per week. That's exactly what I expect to see on Apple, 0.6 to 0.8% with its current volatility in the market. Okay, now, I don't have 100 shares. I bought 500 shares. And I'm comfortable giving up 100 shares at 1.6%. But I do want to keep some of these shares for longer term on the position. Let's say 600 shares, Kenneth. Let's make it a nice round number. All right, so we're going to put in 600 shares. And I'm going to say, all right, 2 of these, I'm comfortable 14 days out. 200 of those shares, Kenneth, I am comfortable getting assigned and making 1.6%. But seeing today was a pullback, but 118 down, it was at 173.70 almost. If it kept that trend and this fear of the CPI and the debt ceiling limit didn't come out today as it did after about, was it 9:45 this morning when the market started to turn? Maybe it was 9:50 a little bit later. I can't remember. But this still could have easily gone up more to 175. So let me do this. Let me keep that same time frame. And I'm comfortable with 1.6 on 200% here. I'm not getting as much time premium or downside protection, Kenneth, here, but I can get $2.50 more intrinsics. This might actually be a 3% return on my next 200 shares on the position. But even if it stays where it is or moves up a little, I might just have to manage these 2, but I get $1.50 here for these 2 or $300 in there. All right. And so now it's showing me an infinite profit, but that's because 200 shares are still not covered. Now, let's say that Apple really exceeds my expectations, but I still want to get a little bit more premium. And I've taken in $850 against, I know, an investment of $103.52. Big bet on 600 shares. I got it. These are large numbers. But it's just to illustrate the point. You could do this with a $17 stock too, taking in 27 cents, taking in 15 cents. It's the percentages that count. So what have I got? I'm maximizing the at the money bell curve with the highest time premium on 1/3 of my shares. I'm giving myself some more upside while still generating a good downside protection of almost 1%. 1.5, current stock price of 172, so just a little bit below 1% for the downside protection on these two, with another 250 of upside. And then I'm just going to exceed it, and not exceed it, but shoot the moon here, and saying if it really exceeds my expectations, let me collect another $60. I know it's not much, but just in case the stock goes up to 180, I don't think it's going to. I think that's the highest point of my expectations, but let me sell 2 there as well. All right, so now the max return you see in this trade, if it's up here, is going to be that profit of 2867 or 2.8% in 14 days. Okay, why is that relevant? Well, again, we already saw, if I did these 6 with the at the money, not giving myself some more upside, but maximizing the profit, that return was only 1.6% if assigned on all shares at 172.50 with a 275 price. What if we did all 6 here? Again, we're only generating about a 0.9, 0.8% downside protection, 1.5 divided by the 172, right? So, but if assigned on all 6, it's 2.3%. Smaller downside protection against the position, $1.50 against $172 stock, 6 contracts apiece, max return of 2.3%, less than what we would have seen by doing the laddering. Now, of course, we could shoot the moon. Deep out of the money, not so deep, but low probability of being assigned in 14 days, maybe. We can check. We didn't check the probabilities, but you see what I'm saying. Lower probability of being assigned, Kenneth, taking in 30 cents. What's that 30 cents? 0.3 divided by our price. Oh, sorry. Let me do that again. I'm sorry. 0.3 divided by 172.50. It's barely 0.2% downside protection. Okay? What you'd expect. It's very little hedge against the stock price if the stock falls. 30 cents. But if assigned, you make 4.5%. But you only take in 180 total. So there are pros and cons to breaking it up in this fashion. You saw that we had the highest maximum return if assigned if it went above 180. Okay, second most. But what's the balance here? If we did the break of 2, 2, and 2, and that's not the only laddering type you can do, Kenneth, but if you do the break of 2, 2, and 2, we saw that we had the potential of a 2.8% return, and the premium that we were taking in was a reasonable downside protection against the position. If we did 6 at the money, we would have gotten the highest downside protection, meaning the most premium taken in, but we would have been at a total gain of only 1.6%. Not quite half, but significantly less than the latter. If we did just the 6 OTM, we were around that 1%. It was really about 0.8, 0.9% protection, but we saw a good return of 2.3%. Relatively close, but much less premium for the downside and much less premium than here. And then going out of the money, we see the highest return, but your hedge for premium is the lowest. It's only about 0.2%. Yeah, 0.2%. Sorry about that, folks. So it's a balance, Kenneth. What are your goals for the stock? This relates to the question that I had with, as I mentioned on the coaching session Thursday with Asif, excuse me. And his question was, he's been playing with options. He's been going back and forth between, he's looking at naked puts now, but he's been doing covered calls. And he's decided that instead of doing it this way, he just wants to, he's using Google. And is there anything wrong with just selling out of the money strikes against Google week by week by week? 2 strikes out of the money. And we talked about what are your goals as far as premium that you want to generate per month. Sorry about that. Let's go. There we go. Okay, there we go with Apple. Now I'm just going to, we are just looking at the calls. Fantastic. And what do I mean by premium? I'm talking about the time value premium. Month by month, what are your targets? Is it closer? You try to generate 1% time value. There it is. I'm sorry. 0.5 to 0.6% week by week. That sort of is going to dictate what your targets are. Okay. There's nothing wrong with that. But he wanted to know, could he expect to make 0.6 or 0.7% every week by selling, just one strike out of the money call? Google was a little bit more volatile, so we're seeing those numbers there. And the answer was potentially, but now you've got to factor in other things. The stock is not going to just do this. The stock's not probably just going to do this. Sorry, went off screen there, folks. The stock's going to be doing stuff like this, just like regular market and volatile conditions, which means I might get 23, 20. That's a bad example. Let's do the 72. The 175, I might be getting 0.4%. But after today's movement, if the stock starts to go back up to 177 or 180, what am I doing now? I'm paying $2 to $3 to buy back this call. I've got to roll out further than just 1 week to manage it. Now, if it goes on one of the downturns, well, I collected 73 cents as a hedge. I met my mark of 0.4 or 0.5% time value / naked yield. But now I've got to be careful, because if it drops down to 165 and I'm selling the 167.50, if I bought in at 172.57 and only collected 75 cents and then another 65 cents, I can't afford to be assigned at 167.50 because my calls sold well below the cost basis. So, depending on your goals, what you're looking to accomplish on your particular stock, Kenneth, what your targets are for the return in your portfolio and the return of the strategy that you're using in the portfolio, covered calls in this case, there's nothing wrong with doing the laddered approach. And I hope I explained the rationale well enough for you, where you can see that you can take advantage of higher premium by splitting it up and doing part of it at the money, part of it slightly out of the money, part of it further out of the money, still having a reasonable downside protection, better than just using the full out of the money strike with the higher upside. But you might be giving up a portion of your shares. We used a 3-ladder one. That's a possibility. Now, don't want to get too much into this, of course, because we're right at that time at 5:50. But if you have any follow-up questions, Kenneth, please feel free to let me know. That's a laddered approach. That's about the strictest ladder approach that you can think of. Keeping the same expiration, using different strikes, targeting an average of what you want to see for your return if assigned on all strategies, and the downside protection, i.e. premium against the cost basis total that you wanted. Other laddered approaches are a little bit different, but similar. You bought a stock at 172.57. Your target for the stock in the next 20 days is 177.50. Let's do that, 177.50. And you think the stock could continue up and the market's going to be good. 30 days after that, you think it might reach 185. And 3 months or 2 months after that, 60 days after that, now we're roughly 180 days in, 6 months out in time, you think it could go back up to 190, possibly 195. So another approach is my first 20 days out, I'm selling, I don't have a 177.50, so let's just say 175. I thought there'd be one here too. We're going to sell 2 slightly out of the money 175 strikes. Then another 30 to 40 days after that, let's just go 20 days after that. We'll go out to June. And we said we might think the stock might hit 185. Getting only 80 cents for that. That's not great, but we expect that because it's further out of the money. I'm going to sell 2 there. And then, in about 90 days from now, we think the stock might be as high as, what did I say, 190? And we're going to get 223 for that one. So, and now we're taking in a fair amount of premium of almost $1,000. 1% downside protection, roughly. Okay. Excuse me. I think I misspoke that before. It was 0.1%, and I said 1%. But that's okay. I'm sorry about that. That's fine. And it's hard to gauge a percent return in this case because it's calculated based on the nearest term expiration. But this is a distance laddering. Okay, if you can let this one be assigned on the 200 shares for the return you'd get at 214, or you could choose to roll it maybe to July at that point, between the June and the August. Maybe you go to the July 190. Maybe if there's a 187.50, you go there. And then as you get closer to this 185, if it's going to expire, great. If you have to roll that, then maybe you roll that one up to the 195 going out to September or October. You're doing in that fashion. Nothing wrong with that approach either. I just don't have the statistics and to show you that that works better than just doing all six and rolling month by month by month, or not rolling. Okay, Kenneth, I don't have that statistics because I don't regularly do this. I do this in analysis for these basic webinars on what your expectations are. The important thing is analyzing for yourself and seeing, am I getting the targets I want on my stock with just selling the 500 or 600 shares at or just slightly out of the money 7, 14, or 20 days out in time? Or looking at the graphical analysis, do I get sort of the same protection I want, but more upside by selling the same 14 to 20 days out with using an at the money, one slightly out of the money, and then one further out of the money? Or based on how long-term you plan on being in the position. You don't like risking, lack of a better term, Kenneth, all 600 shares at once. If there's a sudden gap up in price during volatile market conditions, then maybe 2 near-term at the money or slightly out of the money, 2 double the amount of time further out of the money, and then 1 farther out in time, double the other one, maybe in that. So it's double, double, and then double is how someone showed me this. One of the gentlemen who used to work at during the old days of the Options Express Expos in Chicago, Brokers Express, one of the gentlemen we worked with at Brokers Express, this is how he outlined it to me. But at that time, remember, wasn't a lot of weeklies at all. So he was talking about 30, 60, 120 is the approach he was using. That's how he explained to me how he did it. And then you would just focus on rolling this one. Even if the stock went up to 195, you wouldn't concern yourself with the June or the August until you got closer to that time frame. You focused just on the nearest term one, and then you went somewhere in the middle at the next strike price. Then when it was this guy's turn, you do it 10 to 15 days before expiration, depending on how much money it is, or you let it get called away. Now you're working with the 400 shares. It's an interesting approach. It's got to be a little bit more active. But the one thing I think investors like about this approach, as opposed to what Ernie and I do, where we're confident in our criteria for the covered call screens, the picks of the day, and the naked put picks of the day, rather than using different stocks each cycle, which match the criteria that we want to use, which benefits us and works for us to our target goals. If you're more comfortable just tracking one stock, but you don't want to risk, lack of a better term, being assigned on your full boat, one cycle at a time, the laddering technique specifically, I think this timed laddering technique, near term, double that, and then double the second one, going up in strike each time. That might be something, if you're comfortable with one stock, you know it, you know its functionality, you want to hold it long term. But again, in the case of a sudden spike, unexpected move up in the positive direction that you were looking for, Kenneth, you don't want to risk the whole boat. You can have the choice to let them be assigned or pay the price to manage just a third or a fourth, depending on the number of shares of stock you have. 400, some people do 1, 1, and 1. Well, and 1. In that case, they'll do 4 ones at different time frames and at different strikes, or same expirations with different strikes. You can, we're not going to do that. You can boil it down deeper, though, and say, hey, I want to maximize at the money with most of my shares. I have 400 shares. So they might be selling 2 at the money, 14 or 21 days out, and then 1, double that, and then 1, double number 2 that's further out of the money. So they're still 50% of their shares. They're trying to maximize the time value in the shorter term, but then giving more upside with a similar premium, double the time out, and then double the time out at higher strikes. That's the different considerations, and then you start getting down that rabbit hole. So I don't have the answers for you in those different rabbit holes in the warren of the laddering covered call den, for lack of a better term. But just ideas to consider for you to play around with, see what works out for you. But that's the rationale, in my opinion. it does have its advantages, specifically if it's a long-term stock that you plan on holding and you plan on holding most of the shares to keep collecting dividends. You're still getting premium on a regular basis, but you're only focusing, hey, you're still making adjustments every 14 to 20 days. It's just all in the same stock to roll or not to roll those positions. And hey, if I had to roll this June out to a July, this June comes up and I'm moving it out to September, hey, if it expires, it expires. Following Monday, I just sell the September 195, or since it expired at 185, it might be a September 190 of another 2 contracts as well.